Kia ora. My name is Nick Goodall, and I am the Head of Research at Corelogic, the property data analytics company, and we support the banking and finance, real estate, government, telcos, utilities industry, really trying to get them the information and data they require to make better decisions and enable people to build better lives. So today I'm going to take you through a market update on where the market is at and where we believe things are heading to for the rest of 2021. A key focus being what have the government changes announced on the March 23rd had to the market so far in the few months of data that we have available to us today. In terms of what we're going to talk about, I'm really going to cover the recent economic and property data to sort of set the scene of where we're at the moment, talk about, of course, regulation and everything else that we're watching that will influence the market, and then, of course, talk about what lies ahead, what we do think is going to happen for the rest of this year and into next year as well. So first up, it's worth saying that the economy is, of course, performing very, very well, much better than anyone could have anticipated a little on a year ago. And the property market off the back of that certainly continues to grow. First up from economics, I suppose, the key thing here is that we sort of talk about being in a potential phony economic recession. We could have been much worse right now. We know that things still aren't performing 100% because the borders are still closed, but generally doing much better than anyone thought we would be. And certainly when you put us in an international context, we are doing very, very well. You can see part of this from our GDP figures, which have bounced out of that negative turnaround last year. We may have also seen a second negative GDP figure come through in Q1 once we get that data. But with the bounce back we've seen in the last couple of months, when we look at the activity index, which is put together by the likes of Reserve Bank, Treasury and Stats New Zealand, it does look like things have bounced back quite well, though we do have to be cautious around this as it's an annual measure, and comparing to this time last year, of course, is fraught with danger given the fact that we were just coming out of lockdown, we weren't performing at anywhere near the levels of 100%, which you'd expect our economy to bear in any normal environment. When you look at other measures such as unemployment, again, when you look back just over a year ago, expectations were that unemployment could lift it to anywhere of 10 to 12%. We are nowhere near that, and we've probably gone past the peak of unemployment at just over 5%. We've now dipped below that in the most recent read of data as well. So very positive signs here. And according to any other economic sort of measures as well, you can see our economy is performing very, very well. Again, especially when you put that into the economic context as well. Of course, off the back of this, we've seen a very strong property market. You can see very strong sales volumes over the last 6 or 7 months. And the latest data, we're still seeing very strong sales volumes. And the interesting thing here is that sales volumes have likely even been held back further than they could have been if we had more properties available for sale. And this is certainly one of the main factors that has seen the strong rise in property prices, because there's just so very few properties available for sale at the moment. And that means that with strong competition, not much supply, we're seeing prices increase at a very fast rate. We do also expect that these strong sales volumes are sort of, no doubt with regulation coming up, such as loan to value ratio restrictions, we know that people probably brought their purchases forward, and that could also move forward into a situation where we see a sales lull later on. For those sales that would have otherwise occurred and were brought forward will now not occur later. And so that dip away in sales volumes we're likely to see as we come through into the winter months, which is typical every year, could likely be exacerbated. So we do expect the slowdown in sales volumes to occur as we move through these middle winter months before we get into spring at the end of the year, where we may see some part of the market come back, but it'll be interesting to see where the market's at that point, where we might have had a few months of a slowdown in terms of volumes and even from a sales values perspective as well. If we look at sales values, or we look at the property price index to see how things have tracked in the last wee while, look, I mean, it's pretty clear here. You can see the strong tick up in values across pretty much the whole country. This chart on the left-hand side shows us the main centres, and you can see the very strong growth across every single one of them. There are times where, month to month, we do see a little dip, as you can see in Tauranga house price index here, but of course then things took off after a very short lull, and everywhere you can see a very strong growth upwards. The chart on the right-hand side does, however, show that the strong momentum that has certainly been in the market may have started to dissipate, with that quarterly line, the dark blue one, starting to now show some signs of sort of faltering, I suppose you'd call it, before we're likely going to see a bit of a downturn in terms of the quarterly rate of growth. The annual line there, the light blue line, does show that things are continuing on up. But this is what affected by what we call base effects. The fact we didn't see much growth in the market a year ago is still affecting that annual rate of change. And so it takes a while for that momentum to slow down when you're looking at an annual basis, but certainly that quarterly. And even when you look at the monthly measure, which isn't included here, and the most recent sales data that we're looking at, including unconfirmed sales data in the Corelogic database, we are starting to see the performance of many areas starting to slow down on the strong performance that we've seen throughout 2021 and certainly at the end of last year as well. From this perspective as well, and when you look at who's been active in the market, there's been no sort of secret that mortgage investors have been very active in the market over the last couple of quarters. But you can see, this is the light blue line on the left-hand chart here, you can see that so far in Q2, we have seen a slight dip away in the activity of investors, especially those using a mortgage. But we have seen the first-home buyers had previously suffered, maybe bounced back a little in Q2 as that demand from the investors had been reduced by not just the introduction of the loan-to-value ratio restrictions, but also now starting to see some impact, very early days, of course, of the government announcement on March 23, particularly the announcement of the removal of the interest deductibility option for investors to be able to write off their interest costs at the end of the year. So we may have seen a little bit of a sit back here from those investors who are sitting back and taking stock and seeing what the market does before they continue to either add to their portfolio or for new investors to go out there and buy a property as an investment. When we look at those types of investors as well, the chart on the right-hand side breaks down all investors by how many properties they own after their most recent purchase. And you can see the strength most recently has certainly come from those smaller investors, I suppose you'd call them, those with only 2 properties after their most recent purchase. So those would be, what we might term our mum and dad investors who have been taking to the property market as an investment option, and they've seen their wealth increase and they've looked to the future and say, what am I going to do for my retirement? Property market's been very solid, of course, and we've seen many people continue and buy investment properties because of this. The one thing we are looking at in the most recent quarter of data, Q2, which isn't complete yet, of course, is the little dip away in that green line. And that green line is those investors who own 3 to 4 properties after their most recent sale. So still potentially relatively inexperienced, have had one investment property and have recently decided to add to that portfolio. That group of buyers who are potentially going to be mostly indebted, highly leveraged, they are the ones that will be most impacted by all the changes, both the loan-to-value ratio restriction limit and also the announced changes from the government. We have seen a slight dip away in the activity of these type of investors who may have been affected by these changes and so have pulled back their activity either while they wait and see what happens, or they've just been unable to continue to add to their portfolio because they are restricted by those the fact that you need a bit more equity in the market right now because the loan-to-value ratio restriction requires a 40% deposit, or the fact that you don't want to have such high interest costs because that'll affect your profit margins at the end of the year. So we've certainly seen a minor dip in this group, as well as the slightly bigger group, the 5 to 9 properties. But again, it is only one sort of quarter and only a part quarter at that of data, so we don't want to call it too early, but certainly there's signs of a change in terms of who is active in the market right now. And as I said, you can sort of see that from the lift in first home buyers coming back so far in this quarter as well, and be intriguing to see how this plays out when we get a month or two's more data to really see what's happening from an activity perspective anyway. In terms of first home buyers, look, we most recently released the Corelogic first home buyer report. In this, the big addition that we included this time around was some joint data with Equifax to understand the age of first home buyers. And the one really interesting thing here was that the age has actually remained quite steady at 34 years old for the last couple of years. And this is a bit of a surprise to us, mainly because we thought with unaffordability so difficult and getting harder for people, that we might see people having to save for a little bit longer before they can get in the market. And we expected that to impact the average age of those buyers, but hasn't really turned out when you look at the data. And I suppose the key thing here is the fact that KiwiSaver balances have been getting larger and larger. More people have greater funds available to them in those KiwiSaver pots, and it's enabling them to sort of keep up with those prices for now, or they had done previously. But also the fact that we've seen many first home buyers compromise on the location of the property they buy, the types of properties, switching more to those townhouses as opposed to those nice single unit standalone properties. And that's also enabling those first home buyers to mostly keep up with the market, but they are having to adjust their expectations as well. And we also need to note that there are the speed limits outside of the requirements for the loan to value ratio restrictions, where not all first home buyers require that 20% deposit. there is a certain amount of all owner occupiers, 20% of all owner occupiers can be outside that speed limit. And we certainly see first home buyers take advantage of this more than anyone else to continue to buy properties, especially using it to buy new properties as well, where you only need typically a 10% deposit, for instance. So we're certainly seeing that activity keep pace with the market, and those first home buyers age staying at 34. One of the other key things that was really intriguing from this report, and this is the second time we've released this one, was to see the average price or the median price paid by these first home buyers. And typically it's generally pretty accepted that first home buyers buy properties at the lower end of the market, typically around what's called the lower quartile price. But our data sort of says otherwise. It says actually first home buyers managed to stick pretty close to the median price paid by all other buyers, showing that they really do act across the value range of all properties here. And that's seen from the chart on the right-hand side here, where you can see the median price paid by first home buyers in red is very close to that median price paid by all buyers in blue. So much closer to the median than it is to the lower quartile, showing that first home buyers don't necessarily buy their first property at the lower end of the market, hold that property for a while before they work into the market and maybe choose to upgrade later on. They do try and stretch as far as they can to go further and buy that better property if they can, before holding that for a little bit longer maybe as they pay off some debt. So certainly a bit of myth busting done with that data, and intriguing to see exactly how that plays out in the future if we do see continued growth in the market. But so far, while they are willing to adjust their expectations and compromise on some things, they're still borrowing as much as they're allowed to from the banks. And we know with low interest rates, they're enabled to borrow a lot of money and just have to pass those serviceability tests. They're certainly pushing that as far as they can, which is meaning they're heavily in debt, and something we'll talk about shortly, and something that need to be considered when we're looking in the future, especially at the prospect of increasing interest rates, which will start to affect the bottom line of those first home buyers who are stretching as far as they can just to get into the market. But of course, we need to talk about today the fact that regulation has obviously got tighter across the board, and the government has sort of not been ashamed to say that they want to slow down the market. They don't want to necessarily see prices drop, and they do want to see the balance switch more from investors to certainly to first home buyers. And so we've now got a couple of months since that big date of March 23, when the government brought out a pretty bold policy in terms of not allowing investors to write off their interest cost at the end of the year. So now that we've got a little bit of data here, it's not, of course, fully complete, and we're still getting much more sales information to understand the impact of the market. We've got enough data through different sources to see if we have seen any sort of change in behavior of those investors or across the market as well. So firstly, why do we sort of get to this point? I think it's pretty clear that affordability, with such strong growth in the market and incomes not being able to keep pace, that it's got worse for many people. Relatively comfortable for those that already own property, and this is where inequality starts to be talked about. Anyone with assets, and we've seen asset prices grow, have been okay and continue to hold those properties fine. But anyone that's trying to get into the market, those would-be buyers, have been finding it tougher and tougher over the last few years. That's shown by this chart on the left-hand side from the Corelogic Housing Affordability Report, where you can see the years to save a deposit has just been increasing, upwards of 9 years now to save that typical deposit to get into the market, if you require 20%, of course, whereas the share of income required for your repayments, if you've already got a mortgage, has mostly been dropping over the last 4 or 5 years. And that's really showing that divide between current owners and would-be buyers trying to get into the market. If we look across the main centres, you can see some of the differences that have occurred by our main centres. The key thing probably here to point out is somewhere like Tauranga now, which is more or less affordable, and more unaffordable to get into the market now, with the high prices there, especially compared to local incomes, which is the orange line, now actually overtaking Auckland for the last few years and still drifting upwards. And also somewhere like Dunedin, which is the darker line here, you can see it's actually overtaken not just Christchurch in terms of affordability, because prices are so expensive compared to incomes there, but also overtaking somewhere like Wellington, and also now upwards of Hamilton as well. So it's actually much less affordable to buy your first home or get into the market if you're trying to save for that deposit in Dunedin than it is in those other 4 main centres now. So that's a pretty interesting change that's happened only over the last 2 years or so. A big part of, I suppose, why we look at that does show why this year's got so political. The fact that we're seeing increasing inequality, the fact we are seeing the property market become more unaffordable for more people, really leads to the fact that the government had to feel like they had to weigh in. And many people will have the argument either way about whether the option was the right one or not. But the point is, they sort of felt like they had to get in there and do something they did. And I think when we start to evaluate the impact, the potential impact of that change, particularly yes, they extended the bright line test, but particularly around the change around interest deductibility, it was seen as being pretty bold. But we do think that the fact that this is going to be phased in over a number of years for existing investors does temper somewhat the short-term impact of this, especially when you add in the fact that the bright line test exists. And even if you owned or bought prior to March 23rd this year, if you sell within that 5-year period, you're going to have to pay tax on those gains. And that's likely to cause or encourage those investors to actually hold on a little bit longer, because any increased tax bill you're going to have at the end of the year from these interest deductibility changes will be nothing in comparison to the capital gains tax you'll have to pay based on any gain that you've made in that period you've owned that property. So we do expect those investors to hold on longer. Another factor is that we did some, I suppose, testing of what likely impact this would have to the bottom line for those investors. And when you look at the actual sums of those people that bought in the last year, and we've just picked out some typical numbers here. And if you look at an investor who might have taken on a mortgage the size of about $570,000, which is pretty typical for sort of the year 2020, the increased tax bill in the first year or the first year after March 23rd is likely to be about $500. And so we don't think that that sort of increased bill is likely to cause someone to think I'm going to have to sell out very quickly, and certainly not going to, especially when they're comparing against the option of whether they pay a capital gains tax as well because of that bright line test. Yes, this increased tax bill will get bigger and bigger over the next few years, to the point where by 2025, that same person with that same size mortgage will in 2025 potentially have an increase of about $5,000 to their tax bill. And that's going to be something that's probably going to weigh a little bit more on their decision to sell that property, to continue to own that property, and certainly will weigh on anyone that's trying to buy an existing property today, because you will have that increased tax bill straight away, because of course the changes apply to anyone buying an existing property after March 27, and that your increased tax bill, what it would be prior to that, will almost instantly be that $5,000 amount. So that might impact demand, but not necessarily lead to investors who already owned property selling off at a great rate of knots. And we certainly haven't seen that in terms of listings either. So if we look at the new listings coming to the market, we can see it's pretty seasonally typical over the last few weeks. Can't really compare to last year, 2020, of course, that light blue line where we saw the massive drop away in new listings coming to market because we were in lockdown. So no one started to list their property over that period of time. But if you look even compared to the year before, we do start to see this drop away as we get closer to winter. We're starting to see that, seasonally normal. We certainly haven't seen a spike in new listings coming to market from investors who are reducing their exposure to the market or trying to raise some funds, to raise some capital to cover for their extra tax bill that they're likely to get at the end of the year. So we certainly haven't seen any reaction from a supply perspective, not yet anyway. And we start to look at, for those existing properties, we know the tax bill will immediately be impacted. Can we see any change in demand? And we can't really get too much from sales data just yet. You can sort of see anecdotal, but one of the things we do measure here at Corelogic is where any of the banks, when they order a valuation to support mortgage lending decisions, they might, depending on the bank, it goes through Corelogic portals or panels volumes. And so we can see the number of orders for valuations going through the banks. And it's a really good preliminary measure for what mortgages are going to occur, and of course what sales will occur later as well. So good measure of demand for people that want to go and get a mortgage, so increase their debt, and that's going to likely flow through to sales as well. So if we saw a massive reduction on this, we might say, yes, we've seen investors really pull back, and maybe even other types of buyers. What we have seen is that, yes, we saw massive strength over that sort of 6-month period, 3 months before Christmas, 3 months afterwards. If you take the average of that, the dotted black line here, you can see it's relatively high in historical context. But what we have seen is that through the last couple of months, of course, we've seen some holiday periods, Easter, Anzac weekend, so we do see a dip away in volumes. But what we did see throughout May was essentially the bounce back from Anzac weekend, and then it's really plateaued at I'd say a pretty normal level, other than the last 6 months. So yes, things aren't quite as fervent. There aren't as many people going in the banks asking for a mortgage as we saw in that really hot time as the market was going a bit crazy over that period. But what it has done is only dropped about 13% or so. And you'd probably expect that to be pretty seasonally typical as we start to see demand reduce over the autumn period. but it hasn't reduced as far as anyone maybe expected, given some of the coverage that the market or we were getting about the market following that big announcement on March 23. So you'd say, yes, a reduction in demand, but perhaps not quite as significant as we might have otherwise been led to believe, or we could have expected if we did see investors really spooked. I think what we've really seen is many people take a back seat, and probably some investors who are unable to now afford the mortgages to continue to buy because their costs don't quite add up. And one of the things we saw was ANZ come out saying that they will use less of the rent to cover your serviceability checks if you're buying an existing property from now on, and that will affect some investors who now won't be able to get those mortgages anymore. And also the fact that we saw the loan to value ratio restrictions be tightened this year from the 1st of March, of course, at 30% deposit requirement, and then the 1st of May at a 40% deposit requirement. So we're also probably seeing the impact of those changes, and not just those changes from the government as well. So aside from that, we've seen a reduction in demand, but not massively so. And so we don't expect to see a significant turnaround in those values, essentially, of what's being paid. And I think we're seeing that in some of the preliminary data we're looking at, where yes, demand might have been reduced. We know we've got very short supply. And the other thing we've got is, through that very strong time, many would-be buyers who couldn't buy previously, there's this overflow, there's this strong pipeline of other buyers in the market, and they're essentially making up for much of that demand, which has been reduced. So we're still seeing some level of competition for properties, which means those prices are still increasing, even if it's not quite at the rate that we'd seen earlier this year and late last year. In terms of whether there'll be a flow through to increase in rents, so those landlords that might say, yep, there's an increase on a cost on my side, so I'm going to pass that on and increase rents to cover those costs. We don't expect that to be the case necessarily, especially because of these phased introduction of these changes. And certainly when we've seen big changes in the market in the past, where landlords' costs might have increased, depreciation changed about 10 years ago. We have seen healthy homes come into the market as well, and that would increase those landlord costs. We've also seen the ring fencing of tax losses as well, and the potential for that to flow through to lower profits, or those landlords passing on some of those increased costs through their rents. We certainly haven't seen that in the past. And this is Stats New Zealand data. The blue line is essentially the increase in rent per year, and it's pretty consistent. Even when there's a change in the market, we don't see a significant change in tenancies or the rent charged on those properties over time. It hovers around about 3% quite consistently, aside from when you go back a bit further and look at the changes through the GFC, where actually there wasn't much rental growth in the GFC, but prior to that, there was a lot stronger growth. So aside from that, pretty consistent. And even from new tenancies that go to market, so often landlords use the opportunity when their property goes to market to lift the rent. That's the red line here, pretty volatile. You do see that jump up and down each month. And yes, we saw a bit of a no growth last year as there was a rental freeze on through COVID, and people weren't allowed to lift their rents. We've seen that start to bounce back, but it's still sitting at what would be a long-term average, again, around about that 3% so far. But you certainly, when you look back in the history and you see big changes, you don't see that necessarily flow through to a lift in rents. So we don't expect that necessarily happen this time either. We will wait and see. There's potential for this to be a greater change than any of those ones that have talked about in the past, but I think the fact that it's phased actually reduces that feeling initially that we would see a significant impact from these changes, and so we don't expect to see this pass through in rents in the short term. There are some things that we're going to be considerate of, the fact that there is always going to be some unintended consequences of the likes of these changes. We do know that these introductibility changes only apply to existing properties. So if you build a new property, you can still continue to write off your interest costs at the end of the year. One thing that might happen now, we might see actually more competition for those new properties. And one of the trends we've seen over the last few years has been this increase in the share of sales of new builds go to first home buyers. And that's the red line here, where you can see in the most recent quarter of data, you can see first home buyer basically with their greatest share of these new build sales. And it's certainly been an option. You don't have the same limits or the same loan to value ratio restrictions on you if you're building a new property. And so we've seen first home buyers favour those new properties at the expense of some other investors. The fact that investors now are incentivized to continue to build and buy those properties, which is obviously a good thing to see the increase in supply of stock, we may see more increased competition. And so those first home buyers that have been enjoying that option to go to those new properties may see increased competition there, and they may have to start to switch their option back to those existing properties as well. So there could be a bit of a change to the market coming as a result of these changes. Whether it's necessarily a bad thing, if we see that lift in supply, then it's probably an okay result of this. But of course, first home buyers may not see the same share of sales going to them in the next couple of years as they see increased competition from those investors coming to that market as opposed to those existing properties, which potentially leaves those existing properties open for those first home buyers to go and buy instead. We do expect in terms of what other changes might come. Right now, it's being talked about the fact that debt to income ratios may be applied or restrictions may be applied. The Reserve Bank have now provided their advice to the Minister of Finance on this, and we're awaiting the Minister of Finance's decision, essentially, whether he will allow the Reserve Bank to have debt to income restrictions as part of their toolkit. Given the government, the Reserve Bank, sorry, the government, the Minister of Finance's previous points on this, we expect him to allow them to have this. But they won't necessarily have any need or the ability or want to put any restrictions on immediately anyway. They say that even if they do get the ability to do this, they usually go through a consultation period, and it would take about 6 months before they implemented something. So we're not going to see any change here until at least November. And our expectation is that we will see a slowdown in the market by then. So the expectation or the requirement or the need for the Reserve Bank to actually implement any limits will be reduced by that point anyway. But the key point will be that if in future they feel the need to put any restrictions on debt to income ratios, they will have the ability to do that in future, which they've never been able to do so in the past. So that's an interesting change for the market, especially when you look at the data here. And Reserve Bank recently put out some data on how many people, how many buyers were over 5 times their income in terms of the debt they were taking on to secure that purchase of the property. And this is the chart on the right-hand side here, where you can see, especially for investors, which is what the Minister of Finance talked about, potentially putting restrictions on, you can see the levels they've been at, up around 60, 70% of investors have been taking on debt 5 times their income. So any limits here would certainly be impacting the market, and those investors that have been buying may not be able to do so at that same level that they have been in the past. And even for first home buyers, we have seen a lift in that as well. Minister of Finance has been very clear. He doesn't want the limits to apply to first home buyers. So there could be the use of speed limits like we see for the LVRs when they do apply something like this as well. The left-hand chart, just before we move on, shows the amount of investor lending that was done above a 70% LVR, so less than a 30% deposit in the last year without those restrictions. We can see they certainly made hay while the sun shone, but that's been restricted back right down below that speed limit now that the LVRs have been re-implemented by the Reserve Bank. And so we expect their continued or their future activity to be limited because they don't have the ability to go outside these limits anymore. Very quickly, just wanted to look at the state of the market in Australia. There's been a lot of discussion around New Zealand's comparison to Australia. Will we see a flood of people move over there because affordability is better? Well, some of the headline data does show that property values in New Zealand are worse comparable to Australia. That's the chart on the left-hand side in terms of the average value in New Zealand compared to Australia. And the home ownership rate is greater in Australia as well. You can see that change on the top right-hand chart as well. The occupancy rate is also much higher in New Zealand, showing that not only do we see lower home ownership, but we also put more people into those homes. But I think the chart of most interest for me is the chart on the bottom right here, which basically shows that we need to account for the fact that our stock is very different across the 2 different countries, especially when you look at it city by city, where you can see somewhere like Sydney may have a lower average value than Auckland, but you're typically getting a much larger share of units, or mostly apartments in this case, where 40% of units or dwellings in Australia and Sydney are actually units or apartments, compared to Auckland, which is only 24% are those smaller type units, apartments, townhouses, terraced housing, things like that. And there's a similar trend when you compare cities like Melbourne and Wellington, Brisbane and Christchurch as well. Looking ahead then, and there's been a few forecasts published most recently from the Reserve Bank and Treasury. We're expecting a slowdown to occur in the second half of 2021, mostly due to the loan-to-value ratio restrictions coming back, even before we saw the announcement from the government. Now that's even more likely, that slowdown, because of that change, just causing some investors and some buyers to sit back and take stock, but also the fact that the profitability won't quite be as strong for those type of buyers as well. So here's a couple of those forecasts from the Reserve Bank here on the left-hand side. You can see the projection for that quarterly rate of growth to slow quite considerably from their monetary policy statement, which came out in May. We do expect a similar slowdown, but probably not quite the rate that they've put in these charts or these forecasts, but something pretty similar to this. The fact that the last time we saw the loan-to-value ratio restrictions require a 40% deposit from investors, we did see a quite sharp rate of growth drop in that quarterly rate of growth back in September 2016. So we're expecting the same impact this time around. Add on the fact that we've got these changes from a tax perspective, and we do expect that slowdown to occur as we move throughout 2021. We do now, of course, when we're looking a little bit further ahead, have to consider the impact of the increasing interest rates. And in the most recent monetary policy statement from the Reserve Bank, we can now see the OCR forecast, the official cash rate forecast, come back once again. And now the next move is likely to be up as opposed to be down, which it had been, so much over the last year or so, where there was consideration for the OCR actually moving into negative territory. Now that's not really the case. Expectations are for those interest rates to increase. So we do need to factor this in. And many people who, have bought since 2010 have only seen interest rates drop mostly. And so those people who have seen their mortgage payments drop away now need to start to consider the fact that what will they do? How can they afford to hold that property if interest rates start to increase and their payments start to increase as well? So we do need to factor this in terms of a tempering of those expectations of continued growth in the market if people are expecting those interest rates to start to increase. And we're seeing this expectation now flow through to longer term interest rates by the banks. Those 3 and 5 year rates have already started to inch up. And so we're already starting to see this flow through to the market where expectations are changing on what they were even 3 or 4 months ago. So really just to summarize this presentation today, we really do feel this has been the year of property politics. We've seen so much intervention from the government and Reserve Bank, but we do feel like now with all these changes, we're at or close to a turning point in terms of sales volumes and price growth as well. We're not saying price growth is going to stop completely or drop away in the short term, mostly because we've got such short-term supply on the market, also long-term, of course, from building not enough over the last decade or two, but we don't expect prices to drop away because of that. So we'll see a slowdown as opposed to a drop. In terms of our forecast of sales volumes, we are expecting sales volumes to drop away this year compared to last year, and potentially even see a slowdown further into 2022 as the interest rates start to affect the market, and we still see this continued burden of the fact we don't have our borders open for migration and also for tourism, which will slow our GDP rather than where it could have been previous to that as well. So, we need to consider that longer term effect, of course, and we don't expect those borders to be open anytime soon, especially until we see the sort of vaccine rollout really ramp up, which we don't expect to happen until the later half of the year. And expectations of that happening by the end of 2021 are probably a little bit optimistic. Probably going to see that occur through to 2022. So, certainly we're expecting the slowdown, not quite at the rate that we've seen from the official forecasts, but we're not expecting prices to drop in the short or medium term either, just because we're seeing demand relatively hold up quite well, and we haven't seen this supply any change in that. We don't expect any change in supply to come anytime soon either. It's a very slow moving beast, and so that's really going to see some competition for property, which means those prices, or at the very least, hold up over that short term. So that wraps me up for today. Look, thanks very much for your time. I know we don't have opportunity for questions today, but certainly very happy to pick up questions at any stage following today's presentation. Available certainly via email, on LinkedIn. Feel free to LinkedIn as well, and available on Twitter. So, and we'll send these slides around for digestion at your own leisure. And do feel free to get in touch with us. Also, don't really miss an opportunity to plug our podcast. The Corelogic economist and I, we have a weekly podcast where every Monday we get together and we chat about the most recent data that's come out and the impact it might have on the market. So anyone sort of involved in the market professionally certainly pays to pay attention to that and see what's going on. So if you're a podcast listener, please do go check us out. We call the New Zealand Property Market Podcast, and we'd appreciate to hear your thoughts on any feedback you got on that as well. So look, let me say thanks once again for paying attention today, and feel free to get in touch following today's presentation. Otherwise, I will leave it there and say thank you very much, and we'll see you again sometime soon. Bye.